If you operate a business or allocate capital in the Gulf, there is a common assumption that higher oil prices automatically guarantee booming government budgets and flush public sector contracts across the board. Relying on that assumption is a dangerous miscalculation. The GCC has split into two distinct groups: states that can absorb the current price environment without structural damage, and states that cannot. The mechanism causing this fracture is the OPEC Plus production agreement. These quotas act as an unbreakable volume ceiling. Governments cannot simply pump more oil to cover their rising bills when market prices drop. This map shows how that volume cap changes the math for the entire region. Because production limits are fixed, we have to look at the fiscal breakeven, the exact mathematical price of a barrel of oil required for a specific country to balance its budget without borrowing. Right now, Goldman Sachs forecasts Brent crude at $58 a barrel for 2026. At that baseline, almost the entire map sits in the red. When the market price sits below a country's required breakeven, the deficit isn't a future projection. It is active, and the state is losing money. For the private sector, sovereign deficits translate directly to ground-level pain. Government spending is the primary demand driver for construction, infrastructure, and industrial services. Deficits mean extended payment cycles, delayed project milestones, and significant risk for businesses waiting on invoices. Even a price recovery to $90 a barrel improves positions unevenly. Saudi Arabia and the UAE finally clear their thresholds and turn green, but Bahrain remains in a deep deficit. The structural baselines are simply too far apart. Oil prices no longer serve as a universal proxy for regional risk. Assessing counterparty safety now requires ranking each nation by its specific fiscal pressure and break-even requirements. This chart is our GCC counterparty risk scorecard. We've built a matrix to rank the 4 primary nations from the highest fiscal pressure to the most stable, based on their true budgetary constraints. Bahrain carries the highest fiscal pressure in the region. They are currently operating at or near their absolute physical production limits, leaving them no room to increase volume. Bahrain's projected fiscal breakeven reaches $130 per barrel. Because their production volume is relatively small, this high breakeven guarantees a permanent deficit regardless of realistic market conditions. Surviving a shortfall this large forces an operational trade-off. Bahrain relies on external support through the GCC Financial Assistance Fund. This effectively trades fiscal autonomy for dependency management, where spending is shaped by the terms of external creditors. No combination of output increases and price recoveries closes this gap under current conditions. Physical volume scarcity has made Bahrain's deficit structural rather than cyclical. Oman takes the second spot. To manage their risk, they have implemented a structural reform program, including subsidy reductions, and becoming the first Gulf state to introduce a personal income tax in 2025. On the matrix, these reforms successfully lowered Oman's breakeven to the $80 to $85 range. This reduces direct exposure to oil price volatility, but it introduces a secondary constraint. Higher taxes and lower subsidies limit domestic household spending capacity. This leaves the government with less room for a counter-cyclical response when external shocks compress economic activity. For Oman and Bahrain, macroeconomic flexibility is limited. Their domestic economies must absorb external pressure with very few remaining fiscal tools. Saudi Arabia ranks third. Their fiscal position is defined by the high capital intensity of Vision 2030 rather than a lack of production capacity. The scorecard shows Saudi Arabia requires $90 to $96 per barrel to balance its budget. This includes sustained multi-year funding commitments for industrial and infrastructure projects that cannot be easily reduced quarter by quarter. This is a strategic choice. The kingdom holds over 1 million barrels of daily spare capacity, but leaves it untouched to maintain the OPEC Plus alliance. They are voluntarily choosing to run absolute deficits at current market prices. The operational trade-off hits contractors through project sequencing. To manage the deficit, the government phases execution over longer horizons, forcing private firms to absorb larger working capital requirements and longer payment cycles. Finally, the state with the lowest fiscal pressure is the United Arab Emirates, which functions as a diversified economic fortress. On the matrix, the UAE boasts a low $50 to $65 break-even. Close to 75% of their real output comes from non-oil sectors, creating a revenue stream that responds to domestic activity rather than global price cycles. They have expanded production capacity, but quota limits delay the monetization of that investment. However, their diversified revenue structure absorbs that delay with relative ease. The outcome is a budget that nears balance, even in a low-price environment. The UAE offers the region's most stable government payment cycles and the lowest counterparty risk. Saudi Arabia offers generational scale at the cost of payment reliability, while the UAE provides structural insulation. This marks a permanent divergence in fiscal architecture. The immediate test is the next OPEC Plus production review. Any adjustment in quotas will likely widen the gap between these nations, rather than close it. If quotas increase, capacity-rich nations like the UAE and Saudi Arabia gain immediate fiscal relief. But capacity-constrained nations gain nothing, because nations like Bahrain and Oman cannot physically pump more oil to benefit. We map these realities into a private sector risk assessment tool. This quadrant chart plots market scale against fiscal reliability. For conservative operators, the UAE is the primary target for stability. It sits in the top right, maintaining commitments regardless of commodity cycles. Their revenue structure ensures standard payment performance and government obligations remain consistent, even when oil prices are volatile. Saudi Arabia occupies the top left. It is the destination for contractors chasing sheer volume and generational project size. The trade-off for this scale is the need to finance your own operations. Businesses most model for phased payments and extended timelines rather than relying on contracted delivery dates. For regional expansion into Oman and Bahrain, the strategy must shift toward capital preservation. Surviving in these high-pressure markets requires prioritizing contracts with confirmed funding tranches and shorter payment cycles. Credit risk monitoring here must be a daily operational priority. Treating the GCC as a single economic unit is a structural error. In a market defined by production caps and diverging breakevens, assuming an invoice will clear simply because oil prices rose is an invitation to capital loss.